It's 1802. Napoleon Bonaparte has just been anointed the consul for life of France. The world is bracing for the eventual Napoleonic Wars. Had you asked any European or even American what the best investment to make in 1802 was, the most popular answer would have most likely been gold. Few, if any, people would have said investing in American enterprise. The U.S. had just appointed Thomas Jefferson as president after a contentious term from John Adams. The country was also drowning in debt, with a national debt figure of $81 million. And that was just the beginning of the bad news. In the following year, the Napoleonic Wars started and lasted through 1815. Then we had the Civil War, 2 world wars, the Spanish flu, the Great Depression, Korean War, Cuban Missile Crisis, Vietnam War, 1973's oil crisis, inflation, stagflation, Black Monday in 1987, September 11th, the global financial crisis in 2008, COVID-19 in 2020, and hundreds, if not thousands, of other negative headlines interspersed throughout that entire period. If you had known that all in 1802, would you have invested in U.S. stocks? Chances are most of us would have said no. But despite all those negative headlines and very real, terrible events, $1 invested in U.S. equities in 1802 would have grown to $2,170,948 by 2023, and that's even after considering inflation. The nominal value would have been much higher. Considering the nasty headlines from 1802 on, you'd have thought that gold would have been the best investment you could make. However, a $1 investment in gold in 1802 grew to $4.18 on an inflation-adjusted basis. U.S. Treasury bonds grew $1 to $1,463, and U.S. Treasury bills $237. So excluding starting a business, which is obviously the source of the vast majority of extremely high net worth people in the United States, owning a diversified basket of public U.S. companies has been the single best investment that the vast majority of Americans and others across the world have access to. In the preface to his book, Stocks for the Long Run, Jeremy Siegel writes, "Over long periods of time, the returns on equities not only surpassed those on all other financial assets, but were far safer and more predictable than bond returns when inflation was taken into account. There is a foundational logic to why stocks tend to do well over the long term. Equities represent ownership in dynamic, adaptive enterprises. Companies are dynamic. They have the power to increase prices, create new products and services where none previously existed, and optimize costs, which tends to give them a natural inflation hedge. In short, stocks represent a claim on human ingenuity and progress. Sometimes we get this wrong. Sometimes we go through periods where we have a retraction in overall progress, economic and otherwise. Over time, however, the general trajectory of U.S. economic activity has been positive. If you look back even 100 years, the amount of luxuries and conveniences and advancements in technology that we have today is simply mind-blowing. The fundamental belief that underlies investing in stocks today and at any point in history is the fundamental belief that the human impulse to innovate and solve problems is a more powerful force than the human impulse for conflict or the cyclical nature of political debate. And speaking of conflict, the big news, obviously, for the first quarter of 2026 has been the conflict in the Middle East. And as much as it may feel like major geopolitical events are going to wreck the stock market, historically that has not been the case. If you look back at data going back to Pearl Harbor in 1941, the general stock market has only declined about 5% on average in major geopolitical events. The main thing that markets respond to is not that there's a conflict, but whether that conflict is going to have a material impact on companies' ability to earn money, especially over a long period of time. And in general, conflicts don't have that large of an impact on earnings. Plus, they also tend to have a positive effect for some companies, in this case, oil companies and defense companies. So there's a natural hedge if you own a diversified portfolio. Even if news is particularly bad overall for society, that doesn't necessarily mean it's as bad as it seems for the U.S. market. However, it is important to remember that we are heading into a midterm election season, and typically that has been a rough time for stocks. If you go back to 1961, the average market drawdown in a midterm election season was 19.4% top to bottom. But if you look at the 12 months following that market drawdown, the average return for stocks has been 31%. Our view is that even if the Iranian war gets resolved, which it seems like it is likely to do, we would expect volatility from midterm elections to start picking up as we head into November. If we do get a more extended correction or bear market heading into the midterm elections, we think it would be an excellent time to consider taking a more aggressive stance with your investments. Midterm election volatility has almost always given way to a relief rally, so it could be a good opportunity to add to more aggressive parts of the market or maybe change your asset allocation to tilt a little bit more overweight towards stocks or get stocks up to your target weighting. While war and political volatility have always been with us, not even the worst of what our world has to offer has shaken stocks over a long period of time. We have no reason to think this time is going to be any different. As always, we're here to answer any questions or concerns you have. Feel free to reach out to us anytime. Thanks for watching, and we'll see you in the next video.